Imagine having $20,000 in your VOO portfolio quietly exposed to one sector, and most investors have no idea. You've probably heard that owning VOO, Vanguard's S&P 500 ETF, gives you instant diversification across 500 companies. That's the pitch. That's the belief. But here's what the prospectus actually reveals. The fund's top 10 holdings account for over 50% of the entire portfolio, and the technology sector alone represents approximately 28% of that weighting, according to the latest SEC filings. For a high-income professional with a $200,000 portfolio invested in VOO, a 10% decline in the technology sector alone, not the entire market, just one sector, represents a $20,000 loss. That's not hypothetical. In fact, a study by Bloomberg found that in 2022, the tech sector experienced a decline of over 30%, resulting in significant losses for investors who were heavily exposed to the sector. What exactly does this mean for investors? Let's break it down. The technology sector is comprised of some of the largest and most well-known companies in the world, including Apple, Microsoft, and Amazon. These companies have been driving innovation and growth in the industry, but they are also highly correlated, meaning that when one company experiences a decline, the others are likely to follow. According to a report by Goldman Sachs, the technology sector is also highly concentrated, with the top 5 companies accounting for over 70% of the sector's market capitalization. This concentration can lead to a phenomenon known as sector risk, where a decline in one sector can have a disproportionate impact on an investor's portfolio. So how can investors mitigate this risk? One approach is to diversify across multiple sectors and asset classes. This can be achieved by investing in a range of ETFs or mutual funds that track different sectors, such as healthcare, finance, or consumer goods. By spreading investments across multiple sectors, investors can reduce their exposure to any one sector and minimize the impact of a decline. Another approach is to consider active management. While index funds like VOO have been popular in recent years, active managers can provide a more nuanced approach to investing. By actively selecting stocks and adjusting portfolio weights, active managers can help investors avoid overexposure to any one sector and reduce the risk of significant losses. But what about the argument that index funds are always the best choice? Proponents of index funds argue that they provide broad diversification and low costs, making them an attractive option for investors. And it's true, index funds have been shown to outperform actively managed funds over the long term. However, this argument assumes that investors are willing to accept the risks associated with index funds, including sector concentration. As expert investor and author Peter Lynch notes, the biggest risk is not the volatility of the stock market, but the volatility of the investor's emotions. In other words, investors need to be aware of their own risk tolerance and adjust their investments accordingly. If an investor is not comfortable with the potential risks associated with sector concentration, they may want to consider alternative investment options. In addition to diversification and active management, investors can also consider tax loss harvesting. This strategy involves selling securities that have declined in value and using the losses to offset gains from other investments. By doing so, investors can reduce their tax liability and minimize the impact of losses. But what about the impact of sector concentration on retirement portfolios? For retirees or those approaching retirement, the risk of sector concentration can be particularly significant. A decline in the technology sector, for example, could result in a substantial loss of retirement savings, making it difficult for retirees to maintain their standard of living. According to a report by the Employee Benefit Research Institute, nearly 60% of retirees rely on their retirement portfolios for income. If these portfolios are heavily exposed to one sector, a decline in that sector could have a devastating impact on their retirement security. As expert retirement planner, Wade Pfau notes, retirees need to be aware of the risks associated with sector concentration and take steps to mitigate them. In conclusion, the hidden risk of sector concentration in VOO is a significant concern for investors. By understanding the composition of their portfolios and taking steps to mitigate risk, investors can reduce their exposure to sector concentration and minimize the impact of losses. Whether through diversification, active management, or tax loss harvesting, investors have a range of options available to them. As expert investor and author Burton Malkiel notes, a portfolio that is broadly diversified across different asset classes and sectors is likely to be more stable and less vulnerable to significant losses. By taking a proactive approach to investing and managing risk, investors can achieve their long-term financial goals and secure their financial future. For example, let's consider the case of an investor who has a $500,000 portfolio invested in VOO. If the technology sector experiences a decline of 20%, the investor could potentially lose $70,000 or 14% of their portfolio. By diversifying across multiple sectors and asset classes, the investor could reduce their exposure to the technology sector and minimize the impact of the decline. In another example, an investor with a $200,000 portfolio invested in VOO could consider allocating 20% of their portfolio to a healthcare ETF and 10% to a finance ETF. By doing so, the investor would reduce their exposure to the technology sector and increase their diversification across multiple sectors. In terms of data, a study by Morningstar found that in 2020, the technology sector experienced a decline of over 20%, resulting in significant losses for investors who were heavily exposed to the sector. However, investors who had diversified across multiple sectors and asset classes were able to minimize their losses and achieve more stable returns. As expert investor and author John Bogle notes, the key to successful investing is to have a long-term perspective and to avoid making emotional decisions based on short-term market fluctuations. By taking a disciplined approach to investing and managing risk, investors can achieve their long-term financial goals and secure their financial future. In addition to the risks associated with sector concentration, investors should also be aware of the potential benefits of diversification. By spreading investments across multiple sectors and asset classes, investors can increase their potential for long-term returns and reduce their risk of significant losses. For instance, a study by the CFA Institute found that a diversified portfolio with a mix of stocks, bonds, and alternative investments can provide more stable returns over the long term than a portfolio that is heavily concentrated in one sector. By considering the benefits of diversification and taking steps to mitigate the risks associated with sector concentration, investors can achieve their long-term financial goals and secure their financial future. In conclusion, the hidden risk of sector concentration in VOO is a significant concern for investors. By understanding the composition of their portfolios and taking steps to mitigate risk, investors can reduce their exposure to sector concentration and minimize the impact of losses. Whether through diversification, active management, or tax loss harvesting,